And welcome in another Blockrevision, your daily dose of regular updates on stock market, commodities, crypto, and everything that matters on a stock market and everything around economy that has an biggest impact around. Today we are talking about Chinese Lunar New Year. Right after we'll jump through a possibility of end of hiking cycle around the world, and then we'll jump through elements related to cyclicality um, by and large. So today's episode will be very interesting in my view. So I'm very glad to host you here. And without any further ado, let's head into an intro. All right, and we are with yes, that's the first slide of our presentation. That's the economy view. At first, you might let me know whether we are officially live just by writing something in the chat. That will be helpful for me, as sometimes that the mic or the screen sometimes are making just some issues. That's why I would like to hear from you whether everything is okay right now. So okay, so let's get into economy view. And the first, as I've aforementioned, New Year in China has officially entered this calendar year. And what does it mean for us, for investors? So normally returns during that period are higher, and especially with the data extended to some years that was around 20 or 4, even up to 40 years back, are bringing some results that CNY, that's a Chinese yuan, 40 days prior has gained. Also, that period has ended 5 days after the celebration. So it could be possible that high returns in January in Hong Kong alongside Singapore are due to the good mood brought here with those festive season. So investors might enter the market as early as December to speculate and leave the market some days after celebration at the end of January. So everything should be fine this time, especially with this China reopening. Beginning of the Chinese New Year has been already attractive entry timing for long positions, and adding up this festive moods related to Lunar New Year, that might be something that really may push it forward. And don't forget, with the reopening of China, we expect the growth this year to again exceed the global average. For instance, that was also favoring crypto. Just look at that elements of the bullet point were buying Bitcoin at the end of the first day of Chinese New Year and selling it 10 trading days later would have returned plus 9% on average for all of the last 8 years, showing positive returns. So it means that right now we can assume that it's not only positive sentiment around prior to the event, but also up to 5 to 10 days after. So it may even extend to the beginning of February. And when it takes to seasonality, we may find out that February has used to be a better month than January. So ahead of us, there is possibly a outstanding period in terms of returns, and I do hope it will happen. About the markets, we'll speak over a bit later, but right now we are ending up our Chinese Chinese issue. So recently in 2021, China has been suffering a lot. Results back then due to COVID closing the economy and also the global slowdown has brought us to the point where exports were down 9.9% and also the producer prices fell 0.7%. So right now, with those elements that when considering that COVID will not mess up the party, we may see a very strong rebound in terms of Chinese manufacturers. All right, is it the end of a cycle? So we can find that recently we've been dealing with an increasing pace of hiking interest rates by the third quarter of 2022. Right after, almost in tandem, the most important economies has decided to slow down and put the just take this throttle and squeeze those rates to this when speaking about the US to almost 5% level. Right now, Bank of Canada expecting to slow down for good. So we have seen a situation where Australia and New Zealand, that's also in a hiking period, recently reporting slowing consumer price gains, and that also happening in Canada. But in Canada, there is a much more complicated issue when Bank of Canada appears to set to cap one of the most aggressive tightening campaigns in its history, with what economists and markets expect to be a final 25 basis point increase in borrowing costs this Wednesday. And policy makers will probably stop shouting of declaring on an outright hard to hikes, opting instead to hold the benchmark overnight rate at 4.5%, as they are finding out that their hawkish view doesn't favor the economy growth and gearing it down. So decision is right now complicated by conflicting data. There are elements like still uncomfortably high CPI at 6.3%, but it's getting lower, but the pace of it is still dangerously high. So underlying pressures show a clear sign of abating, and Canada's heavily indebted households are feeling the pinch of high rates and starting to cap the spending. That's why we might be seeing kind of a postponed period of stoppage of this hiking rate, but it will be very interesting to watch indeed what will happen on that date. And as a reminder, if we just get through with those hiking interest rate period, it might be an indication for the world that when Canada will curtail the chase of those hiking interest rates, it might be the one of the front runner amid other central banks, and also the one of the litmus paper what may happen in the US next week, when we have also that decision. Right now we are jumping to 60-40 revival. What is it? It's a 60-40 stems from a portfolio consisted out of 60% of stocks and 40% of bonds. And right now we can find that hedge funds are still over leveraged to the downside of those bonds. So we may see that those elements of overinflation might be the points where we might get back with interest rate hikes. So those hedge funds used to act as a laggards in terms of what bonds may do. That's why there's a high probability of having this interest rate hike eventually got lower. So we can find that when Fed speaks that another increases might be intact, bonds discounting another scenario by breaking downside significant support. And they said that we must not deny the Fed, but this time when the Fed is so divided in terms of further path, it would be better to listen to the market. And this time market says the bonds should rise in opposition to what majority of hedge funds says. So net short leveraged fund positions in 10-year futures have grown biggest since 2019, and by taking a counter position that often favors the profits on the market, that might be the great time just to bet on those bonds. So treasuries have rebounded this year on bets that the Fed will soon call an end and to the harshest rate hikes in a generation, and that may be fueling fast money funds to short 10-year notes against the shorter dated counterparts on expectations that deeply inverted yield curve will soon begin to steepen. So it will be very interesting to watch how it play out, but right now there is a massive hedge fund split that may bring to such heavy losses. That's interesting. Mr. Ken Griffin out of Citadel has churned out of a record 16 billion in profit for clients last year. Citadel's gain was the largest annual return for a hedge fund manager, surpassing the 15 billion that John Paulson generated in 2007 on his bet against subprime mortgages. So Mr. Griffin, unlike other famous investors, is remaining kind of a tight-lipped about his investment strategies and decisions. Despite this, it's not a secret that Griffin has a penchant for quantitative investment techniques stemming from his love and is with mathematics. That what we found, and we know that he himself also selecting the best profiles from different disciplines. So it was out of economic, financial, physicists, engineers, and among others. So we can find that those hedge funds that are making biggest profits has based those techniques on quantitative types of and algorithmic types of trading the markets, when those decisions are making out of than milliseconds. So there is no room for a typical investor or rather trader that would like to conquer with those giants, whether it's Medallion, whether it's Ken Griffin's Citadel or Bridgewater. So right now we can find that those lower intervals are belonging to algorithms, to hedge funds that have a great machinery, I would say, that supports them with very quick, decisive systems. So by analyzing that we may find that we may have find a better place by looking at intervals at least of a 1 hours. That's why I am just showing you the trades and investment opportunities based on at least an hourly scale. But getting back to this issue, we can find that Ken Griffin's upon recent 32 years of running a Citadel just delivered a 65.9 billion dollars out of in gains, whereas during just this year that was already 16. So it means that he generated 25% out of his total return, total gain. So it means that throughout previous years his method wasn't so successful. So I'm strictly need to aware you that those hedge funds very often are becoming the victims of its own success when becoming too big to manage the size of money, and the strategy that worked before with lower size of capital may not work with larger. So when usually those hedge funds are delivering this type of results, those profits are getting more and more vocal, and there are many more market participants that want to get to those hedge funds, and they are loading them with money that when those money are being gathered by those hedge funds, their strategy from then on started to literally crack when those algorithms cannot work out with a such elements of heightened demand on the trades. So they are making, for instance, too many trades at the specific time horizons, and there are too many when they are trying eventually even starting to fight with each other. So sometimes those hedge funds are literally encouraging many people to put the money on them, but after a streak of successful years, those hedge funds are starting to flounder. So you need to be very aware of a recency bias that's right now related to this phenomenon. All right, it's earnings and earnings that might be this week and next this and next month only a doom and gloom, even if it get worse. So earnings typically in the past has been rising throughout a longer period of time, but as we do know, right now we are fighting with a slowdown that may bring lower valuations. So I would let you know why that's not as scary as you might think. So if we just jump to another window, I will just let me find out. 1 second. My Windows has I need to switch the windows. 1 second. All right. So right now, if we just take a look right here, back in 2020, I will just take a sip. Back in 2020, we've seen that was the sharpest recession in the history. Back then, we have on the earnings per share table has dropped significantly. Just have a look at those data. That's year over year minus 22% in the May of 2020, whereas alongside 2020 that was around 26-30%. This time, however, is not bad at all. So we have noted a slowdown right after this enormous gains of 110%. But as we do know, those type of acceleration cannot be maintained. It's really abnormal. So right after this overreaction, we've seen that after getting out of this fiscal stimulus programs and also enormous redistribution of funds by government, we finally are getting to reality. So it means there are no a recessionary period as of now in terms of earnings. That is some concern that it may happen, but for now on, it's still nothing that bad. So right now, we already in expectations have considered that it might be doom and gloom from with this earnings season, but right now it doesn't really converge with those market price valuations going much lower. Rather, the market is trying to repolarize itself and change the path of the least resistance to the upside. That's what we will talk about in a moment. But in terms of earnings per share, once again, I would like to show you the JP Morgan's very nice finding that even if those earnings may drop, we may rise in terms of market valuation. So when earnings has been dropping in 1957 recession, we could find that it was already over for stocks. So stocks always are the leaders in terms of earnings. So in relation to earnings, and that was happening with stagflation era of 1970s as well. Those earnings has been dropping, whereas S&P 500 has already been rising, and that happens almost every time. The only one outlier was the dot-com bubble, where those earnings have been dropping before the market started to reverse, but that was very strong market that literally led to such turn of events. So that was the outlier. Right now, in terms of earnings, we started dropping, but the market already been dropping for a longer while, and it might be more possible that we might be still dropping on earnings, but the expectations of the market might be that we might be already through the toughest time, and from then on, that might be just one way to the future. That might be the upside. So that's the positivity that I wanted to deliver right here. In terms of very interesting also finding periods when to make money, we can find right now that that's in 1872 a man named George Treach created a cycle for buying and selling, and right here it also on a other publications it extends to the past much further, but just look at those periods. So there is some repetitivity where we can find it every single 1820, 16, 1820, 16, 1820, and so on and so forth. Time horizons, we may expect a market cycle to boom and bust right after it. So those with large triangles with apex being moved to the upside, those are the peaks of a cycle. So it's where the markets usually reaching its Minsky moment right after inflecting. And with those lower edges, those are, I would say, lower peaks. Lower, I mean, I would say the narrower time horizons extremes. So just look at recent data. In 2007, we had a lower or narrower in terms of time horizon peak for the US stock market, and that's what has actually happened. Back in 2019, yes, we had a peak, but it has been extended through 2021 when we have peaked on many more indexes. So it was extended to some other time, and the dip right after this peak might be in 2023. So it favors the growth from now on. So not many people know about Treach or his work, but what we may find is that it sometimes his predictions has been really resembling a prophet's work, prophet in a stock market sector. So if we'll just have a look at this broader range of an issue, we may find that those 60 to 20 years periods where might be about the periods where new generations are coming to the market with every those periods, but with shifting, I would like to emphasize that with shifting parenthood to 30s and with those generations, I would say coming out to the markets in a much more rare fashion, those cycles may even extend to broader time horizons. So it's everything hinges on that every generation has its memory of a bull and bear market. When one generation is literally burned on the market, he doesn't want to get back to this anymore. But when the new generations reappear, it usually gets us to another wave of interest in stock market. So that was about 2016-18, and that's what is very interesting in my view. But let me know in a chat whether you find it interesting and what's about it that interesting you the most. So 2023 is the one that we might be watching very carefully, and that's also the implementation of this strategy to the S&P 500. You may stop the video and watch it by your own. So there was a very nice correlation with highs and lows for this strategy of Mr. George Trich. Right now, let's head to market outlook, and what we have right here is let me jump to TNX and especially to SPX. So we are approaching once again this downward line, and this time might be the one where we eventually get through it, as the path of the least resistance is to the upside, when we have tested so many levels below that it might be and literally very low probable that we may eventually get down to those levels once again, at least by now. I do expect that the objective for this price action is at around 4100, and that's where the most of the buying pressure will reappear. So that's in my view a positive outlook for the upcoming days. And what about the laggards? Right now we can find that US stocks are still laggards in terms of any others when taking consideration of China, Europe, and emerging markets. S&P is still the one that needs to rebound and perform better along the way. So as those smaller, more risky assets are joining, right after at the end is the one of the smaller risk, and that's the one that's called S&P 500 to join the party. All right, so we are getting to crypto outlook, and for this one I'll just show you the BTC USDT chart, and we are right now heading through this 20.3 area. So it means there is nothing less and nothing more than just continue the rally. Right now, by this doji candles, the daily doji candles, we may find that the selling pressure doesn't stick out, and that means that another rally towards 30,000 is uninterrupted. But for your knowledge, just remember that buying on resistance is always risky. So we are right now at the resistance of 25,000. So I would wait for maybe another pullback and right after enter. But right now it's not the best time. Anyway, even with those doji been built, I wouldn't catch that wave as at this level. So wait for the pullback if you wanna catch that up. So what about the next element is market movers, and for market movers, just have a look at economic calendar, and at economic calendar you may find that for this week we have out of Australia business confidence. Right after we have inflation rate out of Australia as well. For Wednesday, anticipated data out of Bank of Canada, and we are covering up the week with GDP growth rate out of US that will let us assess whether we are still recovering with a forecast at 2.7% after this 2 consecutive months of negativity, whether we will go head to head with those recent forecasts, and about the Friday personal income out of US alongside Michigan's consumer sentiment. It's also much of a interesting event. So that was about trading economics and earnings calendar for this week. What we have right here. So for Monday, we have Brown, Baker Hughes, Microsoft. For Tuesday, Johnson Johnson. That's also a large company. Tesla and any others. There is Visa. That's also important in terms of how the consumer debts, consumer credit cards are being used in terms of possible stimulation of an economy. And what was it back? Yes, Louis Vuitton, MasterCard as well, and Chevron and American Express on Friday. So there are many prominent names to watch this week. So we'll let you inform what's the revelations out of this in the next episode. So if you enjoy, just hit the subscribe button. And right now, as the time is running out, let's quickly jump to trade idea section. And for this one, I have for you natural gas. That's right now what we can find has formed a very large gap. So it means that this gap is the demand entering the market. So a gap to the upside is a very important indicator of inhibition of this downward pressure. So right now we have got to those low levels where eventually buyers are stepping in, and especially with those support levels at 3.0, right now we might be in the midterm of another wave upwards. So every single downward slide toward this level of 3.08 or maybe even to 3.04 with closing the gap might be the very nice chance to catch natural gas from here, and I will be watching this very carefully. So for this one, as we don't have very strong green candles out of this area, that may be a justification for another rally to commence, I would maybe quite patiently wait for such, and right after, when maybe those gaps will get closed, we may see another upward movements. But right now we can find that the buyers are buying those wicks, so it means that it might be very difficult to get to those levels of 3.04, but for the I would say for the bulls to prove that the rebound is not fakish but the true one, we would need to cross those recent highs on 4-hour candle and get out of this 3.22 barrier with a very nice price action. So you may wait for this one to close the gap at 3.05, or at least if the price action will appoint for the upside, just hang on for 1 hour candle to close above 3.2, somewhere around this level. So in terms of trading area, that will be in terms of the first version. Sorry, in terms of the first version of a trade, I would get anywhere between those boundaries of the blue box, and with a target of at least 3.4. So that will be risk reward ratio at listen carefully, it's 13.6, so it's very decent play. So in terms of this one, that is of a lower risk proposition, I would play it out like that. So if you are about to run with this position, you may hang on to the position even for longer, but it's the minimum objective that might get reached. All right, so today's episode has been very long, I would say, but we had many topics to study. So I'm very glad. I was very glad you have come over. And if you have any questions, just comment in the section below the video, and leave the thumbs up button if you enjoyed. Thank you very much for today, and see you tomorrow, 8:45 a.m. East time.